Welcome to the deep dive. Today we're looking at a really quite astonishing financial turnaround story. We're diving into Bellring Brands Inc. That's ticker BRBR. Now, this is a company that, well, it spent years wrestling with some pretty painful supply chain constraints, but over the past, say, 24 months, it has absolutely roared back. Our sources are calling it a true growth engine. So our mission today is to unpack that 4-year financial journey. How did this consumer health and nutrition company navigate those huge operational challenges? We want to understand how they managed to transform what seemed like a weakness into, well, fundamental financial strength.
And that transformation, that's really the core of it, isn't it? BRBR, they focus on convenient nutrition. Think two main brands, Premier Protein, that's their big market-leading protein shake, and Dymatize. Dymatize is smaller, sure, but it's their fast-growing sports nutrition line. And the main takeaway you see in all the data isn't just, okay, they fixed their manufacturing problems. It's really about how they use that operational fix to fundamentally, maybe even permanently, expand their profit margins. They really turned an internal problem into a powerful profit driver.
That really is the goal, right? Taking a challenge and turning it into a real structural advantage, something lasting. And when you look at the aggregate numbers, you see this dramatic, almost textbook V-shaped recovery. Fiscal year 2022, that was definitely the bottom. They were choked by those internal production limits, plus you had external inflation hitting them hard. But then FY23 and the latest data, the trailing 12 months, let's call it TTM FY24, it just shows this spectacular rebound. Explosive, really. Okay, so let's dig into that V-shape, starting with the metrics that really defined the dip back then.
Right. That 2022 downturn, it was genuinely painful to see in the numbers. Growth slowed right down. Profitability took a huge hit. Why? Well, like you said, they couldn't make enough product, and raw material costs, particularly whey protein, were just spiking.
And the gross margin, that seems like the crucial number here.
Absolutely critical. It fell from, 32.8% in FY21 down to 29.3% in FY22. That's a 410 basis point drop in 1 year. For a consumer packaged goods company, that's just brutal.
It really is. And it confirms the core issue wasn't like lack of demand, right? The consumer still wanted the stuff.
Exactly. The problem was purely operational, supply chain, production capacity. And when you see their operating income margins sink all the way down to 8.8% that year, well, it shows the business was literally choking. They couldn't fulfill the demand that was out there. They were just leaving money on the table.
Right. So fixing the operations, that was step one, necessary. But what happened next? Once they sorted out the production capacity issues, especially for Premier Protein shakes, did the floodgates just open?
That's a good way to put it. The floodgates opened. Once they removed that bottleneck, they could finally meet all that pent-up demand. And that really proved the underlying strength of the business. It wasn't some temporary blip in interest. You had this valuable brand asset that was basically running at half speed because of manufacturing limits. Takes a limit off, and the numbers just took off.
And took off seems right when you look at the cash generation figures.
Oh, definitely. Let's look at adjusted EBITDA. It's a good, quick measure of core operating cash generation, before interest, tax, depreciation. That number jumped from that low point, $230.1 million in FY22, to a really impressive $354.4 million over the last 12 reported months, TTM FY24. But here's the really crucial part, the margin. It didn't just recover to where it was before the crisis. It actually shot past previous highs. It's sitting at 19.9% for TTM FY24. So they didn't just defend their profitability, they aggressively expanded it.
Okay. That leads nicely into the next piece. The turnaround is clear, but was it just about fixing production, or did they actively engineer this top-line growth? Let's talk about what's actually fueling that revenue engine now.
Oh, it was definitely engineered, I'd say.
Yeah.
Especially through pricing. Yes, strong sales volume increases show people love Premier Protein. They were buying whatever they could find. But the real sign of a strong brand, a strong asset, is what our sources call strategic pricing power.
Okay, this is where it gets really interesting, right? Because they raised prices during that FY22 inflation crisis. Normally, what would you expect to happen then?
Well, the typical playbook says if you hike prices significantly, especially on something like a protein shake where there are alternatives, your volume stalls or even drops off, people switch to cheaper options.
But that's not what happened here.
Not at all. What's fascinating is that BRBR's volume growth kept going even after those price increases. Consumers just accepted the new higher price. That demonstrates pretty significant pricing power. That brand, Premier Protein, it's acting like a powerful economic moat, The customer loyalty, the perceived value, it's strong enough to overcome that normal price sensitivity.
Okay, but let me push back a little here. Does that imply they might have been maybe underpricing the product before the crisis if they had that power all along? Did inflation just give them the excuse, the cover, to finally adjust prices to where the market would actually bear them?
That's a really sharp point. And yeah, it certainly suggests they might have been operating below what customers perceived as maximum value. Inflation likely provided that external justification, the reason they could message the price hikes. And it allowed them to lock in higher profitability. It might have been much harder to justify those same hikes during, say, stable economic times. They definitely seized the moment. They reset customer price expectations higher, probably permanently.
And that stability, that power, it seems reinforced by their portfolio strategy, too, this two-pronged approach. You've got Premier Proteins, the big engine, the market leader, pulling in over, $1.46 billion in the last 12 months. Its growth now is about getting into more households now that they can actually supply the product.
Exactly. And then, like we mentioned, you have Dymatize. Smaller, yes, but strategically vital. It's the high-growth flank. It had a huge growth rate, 25.9% in FY23.
Right.
That's significantly higher than Premier Protein's 15.9% in the same period. And that dual structure is just smart business. You balance the massive, stable base of Premier with the faster growth potential of Dymatize. It helps them capture growth in different market segments and, crucially, reduces their dependency on just one single brand, however strong it is.
Right. Okay, let's connect that story. Strong sales, pricing power back to profitability, that margin mastery you touched on, going from that 29.3% gross margin low point up to 35.8% today. I mean, that's a huge structural win.
It really is. And this dynamic is probably the most powerful part of the whole analysis. They experienced what some analysts call the flip. Basically, starting in FY23, their raw material costs, especially that key ingredient whey protein, they stabilized.
Yeah.
And then they actually started to drop.
Okay, costs going down. So what was the key move brbr made then? Did they pass savings on?
No. And that was the genius move, really.
Yeah.
Simple, but effective. They maintained the higher prices they'd already put in place during the inflation peak. So input costs drop, but selling prices stay high. What happens? They basically pocketed the difference. That combination, lower costs, sustained higher prices, it led to absolutely explosive gross profit growth, up 39% in FY23 alone. And record margins. That is almost the textbook definition of converting an external threat, like inflation, into a permanent, sustained profit boost.
And that leverage, it seems like it flowed right down the income statement, too.
It did. They managed their SG&A, selling, general, and administrative costs pretty efficiently. Combine that with the sheer scale of the sales growth, and you get significant operating leverage. Their operating income margin expanded dramatically. It climbed from that crisis low of 8.8% in FY22 all the way up to 14.9% TTM FY24.
And you can sort of see the management's confidence in how they spent money too, right? Once the supply issues were fixed.
Yeah, that's a great indicator. Once they knew they could actually make the product consistently, they strategically increased their marketing investment. They weren't just, hoarding cash. They knew they had the capacity, so they started spending to build that long-term brand equity, drive future demand. They even raised their financial outlook, their guidance, based on this renewed confidence. That tells you a lot.
Okay, let's shift gears slightly to the balance sheet because they have a different kind of operational approach there, this asset-light model. They rely heavily on co-manufacturers, right, instead of owning big factories themselves. What's the strategic upside there?
Well, think of it like this. They own the valuable part, not the brand, the formula, the customer relationship, but they don't own the expensive, capital-intensive factories needed to make the shakes and powders. That means their capital expenditures, or CapEx, are relatively low. They aren't spending billions building and maintaining plants, and the big benefit of low CapEx, it maximizes their free cash flow, cash that they can then use for other things.
And it seems their clear priority for all that extra cash flow has been paying down debt. Not just letting it happen, but actively, aggressively doing it.
Aggressive is definitely the word. Look at the numbers. They paid back $285 million in debt in FY23 alone, then another $90 million just in Q2 of FY24. And the best way to measure how much this reduces their risk is the net debt to adjusted EBITDA ratio. Basically, how many years of operating cash flow would it take to pay off all their debt minus cash on hand? That ratio has dropped significantly. It was 3.8 times back in FY21. Now, over the last 12 months, it's down to just 2.1 times.
Okay, so for the listener, why should they care about that specific ratio? Going from 3.8x down to 2.1x, what does that actually do for the company?
It fundamentally changes their financial stability. It means they've built a huge financial safety net. Their debt used to be almost 4 years' worth of their core cash flow. Now it's barely 2. This systematic deleveraging, first, it reduces their interest payments. which directly helps net income. But maybe more importantly, it gives them tremendous financial flexibility. When your balance sheet is this strong, you're ready for opportunities. Maybe M&A, maybe big share buybacks, maybe starting a dividend. They're securing the foundation for whatever comes next.
Which brings us nicely to the final strategic outlook. If we pull all this together, the pricing power, the margin expansion, the debt reduction, what's the core conclusion? It feels like a real maturation of the company.
It really is a fundamental shift in their risk profile. You could say they transitioned from being a business limited by internal problems, we can only grow as fast as we can physically make stuff, to being a business driven by external market potential. Now it's more like we can grow as much as the market demands. They proved they could scale up their co-manufacturing network, removing that internal brake. So now all their energy can go into building the brand, innovating, capturing that market demand. It's a profound shift.
And if we just quickly recap the strengths versus the potential headwinds now.
Sure. On the strength side, that dominant premier protein brand, the now proven pricing power, the effective dual brand strategy with Dymatize, those are clear winners. Plus, the asset-light model generating strong free cash flow, and just the rapidly improving financial health. Look at return on equity. It surged from about 7% in the crisis year up to over 15% recently. That's creating value fast. But, there are still headwinds to watch. They're still exposed to raw material price swings, even if they managed it well this time. Relying on that co-manufacturer network, while asset-light, introduces a different kind of operational risk. What if a key partner has issues? And, well, they're still heavily concentrated on the premier protein brand, even with Dymatize growing.
Okay, but weighing it all up, the story is incredibly compelling, isn't it? Bellring Brands tackled its operational nightmare, proved its brand strength through pricing, and fundamentally repaired its balance sheet. It's a really impressive turnaround based on, well, smart execution.
It absolutely is. And the fact they've been so successful, so focused on paying down debt, means they're rapidly approaching, or maybe have already hit, their main financial stability goal, that net debt to EBITDA ratio below 3.0x. And that very success raises the next big strategic question, something for you, the listener, to think about. Management showed they could successfully channel massive free cash flow into debt reduction. Great. But once that debt target is comfortably met, what becomes the new priority for that growing pile of cash? Will they double down on marketing for brand expansion? Will they look for a big acquisition to diversify? Or will they start returning more capital directly to shareholders through buybacks or maybe even dividends? That decision, that capital allocation shift, that's really going to define the next chapter for Bellring Brands.
That shift in how they use their cash is definitely the next key thing to watch. A fascinating story. Thanks for joining us on this deep dive into how a company can turn operational pain into real financial strength.